Hello and welcome to the Daily Brief by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I am your host Anurag Bansal, and in today's episode we'll talk about 6 big stories. First, we'll talk about the massive tech breakdown that happened on Friday, which affected all kinds of companies. Second, we'll talk about the government's new plans with PSUs. Third, we'll discuss RBI's latest report on the Indian economy. Fourth, we look at how Netflix's performance is in India this quarter. Fifth, we look at interesting insights from Infosys' latest earnings report. And finally, we'll also decode Paytm's quarterly earning results. In the first story of the day, let's talk about a major tech breakdown that happened on Friday. If you've seen the movie Die Hard 4, it is like all of it played out in reality. Well, if you haven't watched it, no worries. Let me explain it to you. The movie showed how a cyber terrorist tries to take over America's critical infrastructure. In that context, let me explain what exactly happened on Friday. See, CrowdStrike, which is a major cybersecurity software provider, faced a major issue. For more context, their software is used worldwide by stock exchanges, airlines, hospitals, law enforcement agencies, and also tech companies. Before moving ahead, let me explain very simply how CrowdStrike basically works. Well, you first install their agent on all your devices, which is laptops, servers, etc. This agent then talks to a central CrowdStrike server in the US. This is supposed to protect these devices from cyber threats. On Friday, CrowdStrike forcibly updated this agent. Now, instead of improving security, Windows systems got corrupted and went into a loop where they kept restarting. And because of that, all devices with CrowdStrike became useless. The result was a worldwide chaos. Major banks, airlines, airports, stock exchanges, stockbrokers, and hospitals were all severely affected. Now, this is surprising to think that all of it was caused by an issue in just one piece of software. This incident is very similar to an issue with Cloudflare, which is another key software used globally. That issue also once knocked out pretty much all of the internet. Now, it's very scary to think about how problems with just one critical software provider can not only affect the internet, but also have real-world implications. And here we are talking about airports shutting down and hospitals being severely affected. Moving on, let's discuss the government's new approach to public sector undertakings or PSUs. But first, let's understand a bit of history before we get into the story. See, after independence, India didn't quite have enough private capital to build everything we needed. So the government set up Central Public Sector Enterprises or CPSEs. This was done in some key areas. Now, over time, the number of these government companies grew by quite a bit. Fast forward to 1991, India underwent liberalization and suddenly divestments and privatization became a hot topic. Now this debate continues even today, but let's not get into it. See, as of 2022-2023, there were 254 PSUs and 193 of which were profitable and 57 were loss-making. Now there are two sides to this privatization debate that you're talking about. One side says that the government should govern and not really run these companies. They point to losses, poor quality, and inability to compete with private firms. And the other side, which is the second one, comprises mostly of politicians, and this argues that we are selling family silver. The truth is probably somewhere in the middle. Yes, of course, some PSUs are bleeding money, and both the NDA and UPA governments have tried to sell stakes in PSUs in the past. Every budget usually has a divestment target, but here's the thing, in the last 5 years or so, the government hasn't met these targets. They're not even close to it. And if you're wondering why I'm bringing this topic up now, let me explain it to you. See, Care Ratings estimates that the government could raise 11.5 lakh crores by selling PSU stakes while still retaining 51% ownership. And you'd imagine that this is a lot of money. However, according to a new Reuters article, the government might be changing its strategy now. Instead of selling PSUs, they're probably considering improving management and making them profitable from now on. The plan seems to be to sell non-core assets like land, reinvest the money, and try to turn these companies around. Now this is just a report. We'll know for sure when the budget comes out on Tuesday. I'll cover more about this as and when we have more information. Moving on, let's talk about the RBI's latest report on the Indian economy. See, RBI puts out this report every month and the July edition has some very interesting insights that I would love to share with you. Let me break it down into very quick pointers. First, India's economy seems to be on a roll. The RBI thinks that our GDP this June quarter will be 7.4% higher than last year. All the high frequency data points to this, and the RBI believes that this growth will continue. A better than average monsoon means good things for Indian agriculture. The prospects of both our services and manufacturing sectors also look really bright. Second, there's something we haven't seen in a while. India registered its first fiscal surplus in 22 months this month of May. If you're wondering what a fiscal surplus is, it is when the government spends less than it earns. This happened because the government's income went up, especially from income tax, while spending stayed flat. Third, there is still a problem that doesn't seem to go away, which is food prices. The RBI's job is to keep inflation at around 4%, and they are trying their best. They've hiked interest rates 6 times from 4% to 6.5% in 2022 and 2023, but food prices, after falling for a bit, have been climbing steadily over the last year or so. This June, vegetables were almost 30% more expensive than last year. You can of course blame it on the horrible summer and all the heat waves. Fourth, there is an interesting trend playing out. People are going crazy for SME IPOs. Small companies are now listing on the stock exchange to raise money instead of just relying on bank loans. In 2020-2021, the median SME IPO was oversubscribed by 1.42 times. Fast forward to 2023-2024, it is over 62 times. That is even more than main board IPOs. Fifth, lastly, foreign investors seem to be back in love with Indian markets. After pulling money out for 2 months, they've invested $5.3 billion in June 2024. A lot of this went to finance, telecom, and consumer service stocks. Why the sudden interest, you might be wondering? Remember, we had talked about the Indian government bonds being included in JP Morgan's Emerging Markets Bond Index in our June 26th episode? That is playing a big role here. Let's now move ahead and talk about something very interesting. Netflix recently released its earnings for Q2 of the financial year. What is fascinating is that India has now become Netflix's second largest paid subscriber market. Now, given that India is a relatively low ARPU or average revenue per user country, which means Indians are usually considered price sensitive, Netflix's massive growth is very interesting. It is even more interesting because until a couple of years back, Netflix was really struggling to stay alive in the country. And there are two major reasons why this was the case. First, their prices were sky high as compared to other OTT players like Amazon Prime and Disney Hotstar. Back in the day, Netflix's top plan used to cost about 800 rupees per month, while its competitors charged less than half of it. And second, Netflix didn't have enough shows that really resonated with the Indian audience. Global shows were good to get some subscribers, but not enough to make the Indian masses happy. To give you some more context, Netflix had launched in India back in 2016, but by 2021, it had only 5 to 6 million subscribers. That is really low compared to rivals like Disney Plus Hotstar, which had about 35 million, and Amazon Prime, which had close to 20 million paid subscribers around the same time. So in order to do damage control, Netflix went back to the drawing board and created an entirely new plan to capture India. They announced quite a few changes after that. First, in December 2021, they slashed all their prices by 18 to 60%. This means their entry-level plan's cost fell from 499 rupees to 199 rupees per month. And second, they even launched a mobile-only plan at 149 rupees per month. This, by the way, was the first time Netflix did such a thing globally. Now, all of this growth is also supported by the cord-cutting trend in India, where people are letting go of their cable connections. According to data, the number of DTH subscribers in India have fallen by almost 10 million or 1 crore or 13% in the last few years. Now, Netflix's latest earnings reports show that these changes and investments in India are really benefiting them greatly. India has now become their second largest market globally when it comes to new paid subscribers. This means that the growth has been great. Also, India is now Netflix's third largest market in terms of revenue growth. Netflix's co-CEO is so bullish on India that he believes that the company could hit 100 million subscribers in the coming few years. But see, while all of this is great news, it is not that smooth for Netflix. Just when they thought that they had cracked growth in India, Jio Cinema entered the scene. They launched an annual plan for just 299 rupees. Let me remind you that even after all these rate cuts, Netflix still charges 199 rupees every month. Netflix, however, seems to be determined to grow in India at all costs. To reach 100 million subscribers quickly, Netflix is making big investments in the country. However, Netflix seems to be very determined to grow in India at all costs. In order to reach their 100 million subscriber goal, Netflix is making very big investments in India by acquiring exclusive Indian shows for its platform. Now, moving on to the next story, Infosys recently announced its Q1 financial results. Their net profit grew by 7.1% and revenue by 3.6%. All of this was much higher than estimates and projections. But I'll skip the financial details because news outlets already do a good job covering all of it. Instead, I'll briefly touch upon some interesting trends that are visible from the Infosys earning reports this quarter. First off, attrition, which is basically people leaving the company, has reduced to 12.7%, which is against 17.3% last year. In fact, Infosys also mentioned that they are planning to hire 15 to 20,000 freshers this year. This thought, by the way, reminds me of the hiring problems of companies like TCS and L&T, which I discussed in some of the older episodes as well. TCS, which is a direct competitor to Infosys, recently said that they are struggling to fill 80,000 job vacancies due to skill gaps in India. Now, there's another side to the story that says that skilled talent in India expects a much higher pay package than companies like Infosys and TCS actually offer. But either way, in this case, Infosys seems to be focusing a lot on retaining and also upskilling its employees in the future. CEO of Infosys Salil Parekh also spoke about the company's current effort to become an AI-first company. Now, this is similar to its earlier efforts of becoming a digital-first and also a cloud-first company. To do this, Infosys has already trained 250,000 of its employees to become more proficient in AI technologies. Now see, here's the thing, whenever companies talk about AI, it probably needs to be taken with a bit of salt. And that is because AI has become a global buzzword over the last couple of years. And while all of it seems nice and exciting from the outside, the real impact is still to be seen at scale. Now, according to Infosys CEO Parekh, the company is seeing a strong traction from clients for generative AI programs. He recently pointed out to a very interesting trend. In this trend, enterprises are now focusing on using their own data sets with generative AI models in order to improve impact. Now, it's important to understand that AI shows up pretty much everywhere except in revenues at this point in time. Now, another interesting trend in the IT space is that generalist IT companies like TCS and Infosys have seen single-digit growths in the last few quarters. But on the other hand, more specific IT software companies like Persistent Systems, KPIT, etc. have seen much better growth results. We'll obviously cover this more in detail in the upcoming episodes. Moving on, let's talk about Paytm, which has experienced some very tough times in the past 1 year. But first, let's do a very quick recap for some more context. So it all started when RBI found some issues with Paytm Payment Bank or PPBL's KYC norms and cybersecurity. PPBL got hit very hard. They were banned from taking on new customers or accepting new deposits. This led to domino effects on Paytm's entire business. To add to the chaos, there were some big leadership changes at the same time. Surinder Chawla, Paytm Payments Bank's CEO, quit just after 1 year. Bhavesh Gupta, who is Paytm COO, also moved on. Now, this RBI crackdown is not just limited to Paytm. First, they went after the fintech industry, then Paytm Payments Bank, and recently Kotak Mahindra Bank got hit as well. Now, of course, the entire crackdown hit Paytm's balance sheet quite hard. Let me take you through Paytm's latest quarterly results very quickly. See, Paytm reported a net loss of 840 crore rupees, which was down 36% from 1502 crores last year. Merchant subscriptions are up from 79 lakhs 1 year ago to 109 lakhs in June 2024. This seems to be the only consistent growth area for Paytm. Monthly transacting users also stabilized at around 7.8 crores by June 2024, which was down from 10.4 crores in January 2024. Merchant loans hit a high of 4460 crores in December 2023 but dropped to 2508 crores by June 2024. In the last earnings call, Vijay Shekhar Sharma also admitted, and I quote, "The last 3 months have been quite a roller coaster in the journey of Paytm. We learned a lot of our lessons." Well, that's all the news I have for you today. I hope you found value in this episode. I'll see you in the next one. Take care and bye-bye.